Hi, and welcome to the Richey May's Q3 2024. Geez, years going by fast. Mortgage Trend Series, Market Insights, and we have a special guest today to talk about the election and Isaac Boltansky with BTIG. But before we get started, just like to get through some of the housekeeping things. First question we get is these slides will be available, and we will be posting this recording. But again, today's topic is going to be an interesting one. We've got not only our usual trend series on what the profitability is, but we've also got some tax stuff to talk about. So housekeeping, all participants will be on mute. Feel free to unmute yourself during the Q&A session. Will be at the end. You can also submit your questions during that the question function in your dashboard. Being recorded, we'll get the recording out to you. CPE credits will be available. It's very important that you answer all 4 of those poll questions to get your CPE credits. There will also be a survey at the end of the webinar. We would love your honest feedback about the survey, where to improve it. One of the things is probably less me and more other people is a good response for that end piece. But we'd love to get your survey responses as to how the survey went, the agenda went, and what we could do next time. Real quick overview of Richey May. Been in the business almost 40 years now. We are dedicated to the mortgage banking space. We understand our clients, try to meet them where they need. Full array of services. In fact, getting a tax partner on the call today is kind of a coup, given September 15th is around the corner. So we're really appreciated to have our one of our tax partners on the call. But again, we're deep into mortgage banking and we're deep into policy, and that's why we've got Isaac on the call. So with that, the agenda for today, we have Tyler House, who you all know, kick off with some data trends and positive news. He's going to be smiling the entire time, given some of the recent outlets, recent information that we've gathered from the Richey May benchmarking program. Then Isaac and I are going to go off and wander around for 40 minutes talking about the political landscape and its impact on the mortgage industry. And at the end of that, we're going to loop in Jake Lawrence to do a tax update, and then we'll have Q&A. So real quick, I've already introduced folks, and Isaac's going to give a little bit more of a update on to BTIG and what he does. But Isaac Boltansky is our special guest. He's Vice President of Residential Policy for Managing Regulatory Counsel. And if you don't know Isaac, I say this in all nicety, Isaac is a wealth of knowledge when it comes to policy out of DC. When Isaac sends something out, that is the one thing I read and save so I can then reread it and try to understand it even better the next time. So Isaac, we're really appreciative that he is here. And then from our tax side, we've got Jake Lawrence. And then I think everyone on the call very much is aware of Tyler House, who is our Director of Data Analytics. And as I tell people, unfortunately, he has to share an office wall with me. So, he does still come into the office, even though he has to hear my voice, and nobody wants to hear that. So with that, I'm going to do the first poll question. And remember, the poll questions here, you got to answer all 4 of them to get your CPE credits. So Gabby, if we could pull up the first poll question here. And the first poll question is, what do you think that mortgage origination volumes will look like in the second half of 2024? So, materially higher than the first half, slightly higher, about the same, slightly lower, or materially lower than the first half of 2024. And remember, we've got some Fed movements coming up. We may talk a little bit about rates going on. But in order to get those CPE credits, you do need to answer all 4 of these poll questions. So once Gabby comes in and tells me we've got around critical mass, we will release these poll questions, and then we will turn it over to Tyler to give us some great updates on the Richey May benchmarking data and what it's showing us. So Gabby, how are we doing on the question responses?
Looks like we might still have some people who need to vote. So
all right, I'll tap dance for a little bit longer. Everyone loves to watch me.
Get your votes in if you want CPE credit. It does not have to be right. It's just to show that you were
here. We would like you to answer it right, and there is a right answer. And if you get the right answer, Tyler will give you a prize if you get the correct answer here. So Gabby, with that, maybe we try to go ahead and publish because we've got a lot of material today to go through. So
Okay, any last second answers, come on through now. All right, close that down.
all right. And so what was the most popular answer?
Volumes will be slightly higher than the first half of 24.
All right. Well, Tyler, I can't give you a better lead into that, to some of the data that I know you're going to go through. So with Tyler, I'm going to hand it off to you to go through the financial benchmarking.
Thanks, Seth. You know, I didn't get a vote there, but that would have been my vote too. You know, I'm optimistic that they'll be slightly higher, and maybe not as optimistic as the NBA's forecast, but I'd be totally okay with the NBA's forecast. I think they had about 18% pickup in terms of volume over the second half of the year versus the first half. But anyways, before we jump into the numbers, I just wanted to talk a little bit about the source of the data for today's presentation, or at least the portion that I'm giving. As most of you are aware, Richey May, we've operated a financial benchmarking program called Richey May Select. That includes quarterly financial performance data from over 70 independent mortgage banks across the nation. We've also recently launched an operations and sales benchmarking program, and that includes daily performance on key production and productivity measures on applications, locks, funded loans. And so that was also used for today's presentation. If you have any questions about those programs or any of the data that I'm presenting on, feel free to reach out directly to me, and I'd be happy to talk about or give you more information there. So why don't we go to the next slide? And you know, really, right, this is the positive headline from Q2. It's the major headline. You know, origination platforms had a positive earnings number on average. So that's significant because when we isolate mortgage lending activity from servicing, you know, over the last 7 quarters, we've seen that mortgage lending activity has been a loss on average. And then those companies that were generating a net income on the overall business, it was largely because origination platforms were subsidized by cash flows and earnings from servicing. So it's great to see origination be positive. On the other hand, you know, the average was only 7 basis points. And on a year-to-date basis, we're still averaging a loss of net production income of 22 basis points. So we're not out of the woods yet. But this bar chart that we're looking at on the slide here, it's a distribution of our net production incomes in Q2 from lenders in our retail peer group. So again, the average was 7. It was positive, but still 4 out of 10 lenders had a loss. And as you can see, there was a pretty wide range of profitability during the quarter, from as high as 86 basis points really to as low as a loss of over 100 basis points. And if we go to the next slide here, I've broken out a few KPIs for these two groups. So we're looking at, you know, the profit group is that 60% of lenders that had a positive net production income versus the 40% with a loss. And so there's an 80 basis point difference in profitability between these two groups. And we can go, you know, down the list, go through all these different KPIs. But what we're going to notice is that the biggest variance between these two groups is in their cost to originate. Lenders with a positive net production income had a cost that were almost $1,900 less than the other group. And that $1,900 makes up over 70% of the variance in earnings. The other thing that I'm finding interesting about these two groups is that some of the other characteristics that commonly drive profitability in you know, a more normal market aren't really the driving force for profitability in Q2. For example, the group that averaged more volume, the group that averaged higher government mix, and the group that averaged higher loan sizes was that group of lenders that average losses. And so, you know, profitability in this marketplace continues to be heavily driven upon cost management and finding ways to operate more efficiently. So let's go to the next slide. The other question I think is worth asking is, why now, you know, are we seeing profitability? Because if you look at volume and unit trends for the overall industry, you know, it's not obvious to me that this year should be better than last, because really we've got less volume and less units through the first 6 months of this year versus 1 year ago. And then on top of that, as we can see here, you know, costs aren't actually lower in Q2 of 24 than they were 1 year ago. They're actually $180 higher than Q2 of 23. So really, what's going on here? Why are we all of a sudden seeing, profitability in origination? And there's really two things that I'm noticing that are driving that, or at least two major things. I'm sure there's other factors in there, but the two major things is that we're continuing to see loan sizes trend higher, and then secondary gain on sale margins on a per loan basis are increasing. So, making it possible for lenders to generate a profit, even though we're seeing fewer units and really no improvement in cost. I think the other factor, which isn't as big of a factor because we're obviously not seeing it in cost, but the other factor is simply that we're seeing less volatility or less decreases in terms of volume. So I think having, more stable, predictable volumes is beneficial too, but clearly the biggest thing is going to be, improvement in secondary gain on sale. So looking ahead to Q3, at the trends through the first half of through the first 6 weeks of Q3, we're actually seeing July and August have paced ahead of production this time last year, and obviously that's thanks to a drop in mortgage rates that we've seen recently. Both purchase and refinance activity is seeing a boost. On a percentage basis, purchase activity is 4% higher, and then refinance activity is 70% higher. So that's a big number. Of course, when refis are at historic lows, 70% is not as big as we might, normally be used to it. It's really only driving locks or total locks up by 10%. So we're quite a ways off from calling this a refi wave like we've seen in the industry over the last decade or so. But even so, if we continue to see this 10% increase carry over into September and maybe even October, then just maybe origination platform profitability for the full year is in the realm of possible, just maybe, but of course, the market's been very unpredictable, and we'll have to see how things develop over the next several weeks. And on top of that, we're in an election year, which I think is kind of a good lead in to passing the webinar over to Seth and Isaac. But before we officially pass to them, we got to do another poll question. So remember, you got to answer all the poll questions to get your CPE credit. Everyone's got to, got to get that CPE credit. So here's our question, kind of continuation of what we were talking about earlier is, are you continuing to see kind of increased level of refi activity right now? I know in the first 2 weeks of August is really when we saw that activity. Based on what we're seeing in our benchmarking program, it does look like that's cooling down a little bit. It's still elevated, but cooling down a little bit. So yeah, put in your answer. Be very curious to hear what everyone has to say.
And Tyler, while we're waiting for the right number of people to respond, it's very interesting, right? The trends, that secondary gain on sale is an interesting number that maybe people want to call you up and dive deeper on. I mean, making sure that that's what they're seeing across their base as well. So fewer units, but more profitability. That's usually not a theme that works so well in the mortgage industry, but that's what Q2 results show. So fascinating. Like I always tell people, man, all those norms that we always walk around with that you highlighted, not always come true. So second quarter, very glad to see the average company made money.
Yep, it's good stuff and always keeps things interesting in this industry.
So Gabby,
right,
how are we doing?
We're going to close down the poll now. If you haven't voted yet, I'll give you one more second while I reach to close this. There we go, a few more coming in.
Okay, great. I think that's probably right in line with what I would expect, where we're seeing 60% of lenders are still saying, hey, yeah, we definitely see an increased level of refi activity. And on the other hand, we've also noticed a cooling off. And so those seem right in line with what I would have expected. So good to see.
Excellent. Well, great update, Tyler. And it's great that we're back to average profitability. So I mean, we're not out of the woods yet, as you said. We're trying to make the whole year positive, but Q2 was positive. So that's a good start. With that, let me introduce Isaac. And Isaac, before we jump off and, you and I, figure out what we're going to talk about for the next 35 minutes, why don't you introduce yourself a little bit better, what BTIG does and your role in the industry. As I said, when you produce something, I read it and I reread it several times. So give everyone who doesn't know you a little introduction of yourself and your firm.
Thanks, Seth. So, we're going from the positive of what you just discussed to something decidedly different, which will be the political landscape. As a matter of background, I started my career in DC at the TARP oversight panel back when $700 billion was a big bailout. And I've been on the sell side for 15 or so years now. BTIG is a global investment bank, has all of your normal trading functions and investment banking and research. I'm in research. I write about how policy impacts different markets. Mortgage and housing is my first love. We follow financials deeply, as well as energy, healthcare, and a little bit of TMT when there are sort of bigger macro issues. But, the goal today is to hopefully talk a little bit about the election while recognizing there's a lot of unknown dynamics here. I think there are definitely some mile markers and some things that we can moor ourselves to as we try to figure out how to think about this and how it impacts the industry. So thank you for inviting us. And Seth, just good to be with you, given that you are the trusted voice on all of these market issues. So I look forward to getting to figure it out with you.
Yeah, no, this has been a dream come true to do a panel with you. So, I mean, we're gonna take this on the road, I think. So let's start with the beginning here, right? Apparently we have a presidential election. As much as I'm trying to say there isn't one, as much as I just want to ignore it, we do have a presidential election. So kind of walk us through, team blue, team red, Harris, Trump, what does that really mean from, again, and I'm going to use a terminology that gets us in trouble, but we have two highly charged political organizations in DC that serve at the will of the president. One is the CFPB and one is the FHFA. And that is, they serve at the will of the president. Therefore, they are enacting policies coming from the White House. So let's talk a little bit about where we are today, what a Harris administration might look like, what a Trump administration might look like from a CFPB kind of FHFA standpoint. And I'll just let you rip on it, and I'll probably jump in here with a couple more questions.
Yeah, look, for housing on the federal side, there are three agencies within that alphabet soup that runs DC that matter, right? It's HUD, it's the CFPB, and it's the FHFA. And under HUD, obviously, we have FHA and Cheney, et cetera, et cetera. But HUD, the head of HUD has always served at the pleasure of the president, right? That's a cabinet post. The CFPB and the FHFA, however, were quote unquote independent up until 3 Supreme Court terms ago. And now both of those heads serve at the pleasure of the president. And I think that's important here because we have a regulatory pendulum that can swing so wildly with the election. I think that's part of what we're tasked with going through today. But I think it's also important just to note that I think that negatively impacts our space by and large, right? That we don't have that policy certainty. And I think that's something that I have seen in talking to startups and other companies raising capital. The capital formation around our space and consumer finance is tough, right? Because you don't know the rules of the road. And it's not just, and I know I'm preaching to the choir here, it's not just the federal side, it's 50 states. And so I think that our Frankenstein's monster of a regulatory framework does some things very well. But the vestiges that we have of the dual banking system with state and federal regulators sometimes has some frictions, I would say. But let's go through this. Look, CFPB under Harris administration is pretty straightforward. You're going to see a continuation under Rohit Chopra. Director Chopra has been incredibly aggressive on oversight, enforcement, and has used his bully pulpit to jawbone more than any previous director. He has used his time on TV, public announcements more than any other. He has also used tools that we didn't really think were going to be used, things like interpretive guidance more aggressively. And so he would stay in place within mortgage land. I think it's important to note that this would likely mean more action on closing costs. Look, the CFPB under Chopra, they're like a dog with a bone on this. They look at the work that they've done on mortgage closing costs and say, hey, the total cost of mortgage closing costs have gone up 36% from 2021 to 2023. This is an area where we think that we can move the ball. We also think that it plays well politically. They're going to act here. And I think we can get into what they're going to do later, but I think that's the one area that I continue to see action under Chopra. Outside of that, I think everything is ho-hum in mortgage land. I think what they did in servicing was completely expected, and so I think he'll go and look for other fights elsewhere. Big tech in particular has been an area of focus. Under a Trump administration, he gets fired on day one immediately. He puts his things in a box and he gets replaced. At that point, I think that you have a tonal difference there, where you don't have as much jawboning, you don't have as many enforcement actions, and not as many administrative rulemaking through enforcement type issues. My one cautionary point, though, Seth, is we've got to start thinking about the ideological spectrum as a horseshoe, right? And there are issues at the extremes where you have the the progressive left, and then the populist right agree. And I could truly see a Trump CFPB director coming in saying, oh, they did a lot of work on this RFI relating to closing costs. Maybe there's some things that we should do there. It wouldn't be nearly as onerous as what Democrats would do on the legal liability side to get best execution and lowest cost, but it would still be something. So I think that's an important point when thinking about the Bureau.
And Isaac, when we transitioned to the Trump administration under the CFPB last time, and I'm going to get my numbers right because everyone knows I confuse numbers very quickly, but it seemed like we had a lot of activity from the CFPB under Trump. We just didn't have the fines. We just didn't have the rhetoric, right? We still had a lot of things that they did. It just wasn't headline grabbing, like, here's your fine or you're out of business, right? It was much more subtle. Hey, stop doing that. So it's interesting that you point out that there's probably some topics like lowering origination costs or lowering title costs that are probably going to be present regardless, but the tone and tenor of it is likely to be different. Is that really what you're saying with kind of that horseshoe?
Yeah, I think that's absolutely right. So still going to do things. You can't have that many people in DC without them wanting to do something. But if we learn something from the Trump administration, the first round, I think it was the fines were smaller and they were generally less exploratory with their authority, right? Whereas Rohit Chopra, I think, has gone into avenues that are not as clear from a statutory and legal perspective.
So let's pivot, and I'm going to come back to the CFPB on rulemaking in a second, but let's pivot to the FHFA and Director Sandra Thompson. And like you had said, right, that's now a position that serves, again, at the will of the president. Sandra Thompson certainly came in with a very defined mission. She's been very much focused on affordable housing, underserved markets. Again, under a Trump administration, or like, where do we go, team blue, team red here?
Yeah, so look, if Harris wins, Director Thompson will stick around until May of 2027 and maybe get another term. I think in that scenario, you're going to see them continue to do work on the federal home loan bank reform effort that they have started and gotten just a torrent of pushback on. I think that'll take a fair amount of bandwidth. I think it's also important to recognize that they are still doing work on single family pricing that started with an RFI previously. So that's another area where you'll continue to see tweaks to the LLPA grids, and juicing that cross sub that is the secret sauce at the GSEs will continue. If we have a Trump administration, I don't think that Director Thompson's fired on day one. She hasn't engendered as much disdain among Republicans as Director Chopra has. She's honestly really well respected in DC. And thought of highly. I do think she's probably gone by the end of the first quarter under a Trump administration. And part of the reason there is like silly DC stuff, but if you look at another agency, the FDIC, there are 5 members on the board. You can only have 3 members that are of one party. So I think the odd man out over there is going to be a guy by the name of Jonathan McKernan, who's a director on the FDIC board. He'll have to leave, and he is my pick to become the FHFA director under a Trump administration. Just as a matter of background, he worked for Mark Calabria in Calabria's office at FHFA. Before that, he was Corker's staffer during Corker-Warner. So look, this guy knows mortgage. You can disagree with his viewpoint of it, but he has been Senate confirmed before. He is thought of highly and well respected. He would be the pick for FHFA and probably in that seat by middle of next year. He's a lot like Calabria. I mean, I don't think that he would give as many speeches as Mark did, but I think, you know, very similar viewpoints on things like credit risk transfer, on curtailing the pilot programs, the closed-end seconds, and the title pilot programs, crowding in private capital via pricing, things like that would all be very similar. And then obviously, the ending of the GSE conservatorships, which I know we'll talk about.
Yeah, I'm going to pivot to that one on the GSE conservatorship on your next slide here. So, you know, we're coming up on, I forget if they were old enough to drive last year, right? Because it was 16 years. I mean, the conservatorship's getting close to old enough to drink at this point, right? It's almost getting to 21. So at some point, Isaac, do we ever see the GSEs out of conservatorship? And my subtle question there, a little different question is, you know, talking to a lot of people, right? That spread between the mortgage rate and the pass-through rate has gotten really wide as we've increased LLPAs, as we've increased G fees, and we're at 94, 95, quickly approaching 100 basis points. It feels to me like at some point the private securitization market might want to come in and play in that space a little bit deeper. So let's talk a little bit about GSE conservatorship, getting them in or getting them out, and what that might mean to the private securitization market.
Yeah, look, I'll be quick and then long on this. Look, at the highest level, will they exit conservatorship? Maybe, right? But I'm not super bullish yet on it. I truly believe that if Republicans win the White House, it's going to be on their to-do list. But we've got to keep in mind there are other items on the to-do list. We've got taxes, which we're going to talk about. We've got trade, which we're going to talk about, which again delayed all of this in the first Trump administration. Furthermore, you have yet to see a Treasury Department care about this at all, right? FHFA under Calabria and Thompson have taken steps to move towards the exit. Treasury has never done anything. And in part, that's because Treasury is a creature of DC and they don't see any political reason to act. No one has ever won an election saying, I fixed the secondary mortgage market, right? If anything, there's incredible execution risk. Also, there's some technical issues here. Like number one, Fannie and Freddie in aggregate owe Uncle Sam $300 billion still via the liquidation preference. Number two, there's a little thing called explicit implicit guarantee, which is kind of important. And it's unclear how that would be handled. There's a belief that maybe the current backstop would convey. I actually believe that's true, but we'd still have to get that cleaned up and cleared. And then, of course, finally, the biggest one is why act? DC struggles to address broken things. And as bad as parts of the mortgage market are, I think we would say they're definitely not broken. Fannie and Freddie of today are far better institutions, and they're far better pillars of the mortgage market than they were, I think, back in 07. So I put all that together to say maybe the key here for me, and I will get bullish on the conservatorships exiting, if you see anyone from the Treasury Department seem as though they care at all. And they haven't. They've been terrible dancing partners. They haven't shown up. But if you see, for example, Mark Calabria go to the Treasury Department and play a senior advisor role, then I'll know that it's real. But until then, I'm not giving it too much thought. And that goes to your point on the private label side, that just as Fannie and Freddie are not the institutions they were in 07, the private label market is not what it was in 07 as well.
Yep. Let's talk a little bit about Federal Home Loan Bank Reform, which I know is a near and dear topic to Richey May clients who are IMBs that are looking for it. And obviously, Federal Home Loan Bank Reform, there's a lot of tentacles to this. You know, they were originally designed to set up or support the mortgage market. People are making the argument that they have lost their mission. That's not what they're doing. But again, from an independent mortgage banker's perspective, and I know the MBA has a position on this, but my fundamental question is, well, which assets or what assets could an independent mortgage company all of a sudden pledge to actually get good collateral at the Federal Home Bank so that it could be aligned? I know personally, when I worked for a bank, we used the Federal Home Loan Bank. We pledged portfolio loans, right? Now, mind you, when they came in to audit those portfolio loans, we may not have been able to find the files, but we had pledged portfolio loans to them, right? And we had to replace things occasionally. But at the end of the day, and that's a true story, but at the end of the day, you know, we talk about, okay, I get conceptually you're trying to support housing, but how does that not necessarily crowd out people who are doing warehouse lines or people who are doing MSR financing? Like what could that structure look like that the IMBs could, I know this is a long-winded question that you can say maybe to, but what could that look like from an IMB, Federal Home Loan Bank, or just general Federal Home Loan Bank reform look like?
Yeah, look, at the highest level, I think that we've got to remember when this review of the FHLB system began, there was a lot of optimism in town that non-banks would be granted some degree of access to the system. And then we had the mini squall in markets, in bank markets with Silvergate and others, and they had deep exposure to the FHLB system. And then suddenly it wasn't about granting non-banks access. It was about returning the FHLBs to their mission. Ultimately, Seth, I think that it's good that we did this review. I think that the review uncovered some broader policy issues that are worth considering. But I think the way this is going to play out is the same no matter who is in the White House, because I think that you're not going to have systemic reform of the FHLB system. I think that you are going to see the FHLBs themselves move towards more of an embrace, which you have, of doubling their commitment to the AHP, going from 10% higher. I don't know if it'll be 20% forever, but higher. And I think an embrace of the FHLBs doing a little bit more in the piloting regarding certain affordable and affordable offerings. I think that's kind of where we're going with this, because for the big ticket items, man, you need Congress, and Congress isn't touching those. And so I think this is going to be one of those where the jawboning and public pressure and all that just leads to some administrative changes as is. That's enough to take some of the pressure off of them.
And let's talk. Oh, sorry. Let's talk real quick about FSOC. You put the FSOC warning on non-bank firms, which is a great academic piece, but requires Congress to act. So, you know, does that get any different legs under a team blue, team red kind of concept? Or is that hey, it's a nice paper, and if a large non-depository blows up, they can point to the paper and go, well, we told Congress to act and they didn't do it. I mean, that's what it kind of felt like, but you're in DC. Am I reading the tea leaves correctly there?
Yeah, look, the FSOC, when you look at the Dodd-Frank Act, is one of the most unmitigated failures of the entire law. The FSOC is comprised of all the different regulatory agency heads. It's supposed to be like the Transformers, except not as cool. You know, they all come together and create a super entity, but it doesn't have power. It doesn't have the will to act. And the non-bank commentary is one that we'll have to see every December as part of their annual report, like shaking their fists. Oh, we're so scared of non-banks. It's a CYA move. There's nothing else that's going to happen. The Ginny and FHFA already took meaningful steps here. I think that's the final word for now. So I just tell clients, be aware that in December a big report comes out. You'll see headlines cross, move on.
Move on. All right. So in the spirit of moving on, we're going to move on to the next slide. And this is, again, sort of your policy chart as to where we're at. But I know there's a couple of things you want to highlight here for people that are in the mortgage space. Obviously, that will be important for everyone in this industry. So I'll turn it over to you on this slide.
Yeah, and we're gonna start to set up Jake, who's gonna come in here. But my overarching, I know I've got another few slides, but my overarching point to clients here is next year is going to be all about fiscal fights, right? And I try to highlight here the debt ceiling rears its ugly head again next year. It technically comes back on January 1, but they have extraordinary measures that I think they can use to get us to around August of next year. And that's some back of the envelope math. It assumes that we're going to continue to deficit spend about $2 trillion a year. And so around August of next year, you have this forcing mechanism. My bet is they punt that deadline to the end of 2025, and then that aligns with the expiration of $4.5 trillion in tax cuts from President Trump's package, the TCJI, which we'll talk about later. My call with all this is it's a year of headline volatility, of debt ceiling nonsense, and ultimately we punt the ball, and no matter who is in power, we have to remind ourselves that the most endangered species in DC is deficit hawks, right? And we will just end up spending. Now, the composition of that deficit spending, obviously has differences, and we'll talk about that. But my bet is we end up with a tax package spending 3 to 4 trillion over 10 years, reauthorizing the vast majority of the personal tax cuts. It just depends which levers and which styles based on who's in the White House. But that's our overarching point here.
And then let's swing to the White House. I'm going to swing through the Senate, and then we're going to come back on the tax side. So, if you go to any news media, you could see 10 articles about how Harris is ahead, 10 articles around Trump is ahead, and I think 2 articles how Kennedy is a real influencer in the election. I kind of making that up. But talk to us a little bit. And again, we're not asking you to predict the White House. You do such great work on this thing, but just boil it down in 60 seconds here. How is this going to get decided? Because I live in Colorado. I know where Colorado is voting. So I think there's a few states that matter a little bit more in Colorado at this point.
So I just think that here, all right, I'll make 3 points and then shut up. Number one is I think we have to have humility about how quickly things change. It was literally 1 month ago that Biden stepped aside from running for a second term, right? We have 75 days until the election, right? So who the heck knows what we're going to be talking about? I think having some humility on that and realizing that there can be global developments or domestic developments that change the narrative in a heartbeat. Number 2 is, and I make this point and the slide highlights it, in a time of uncertainty regarding everything, I think it's important to focus on the swing states that'll decide this, which are those 7 states there, and then what animates the voters in those swing states. And this is a poll of those swing states, and it says what is most important to you when you're deciding who you're going to vote for. The first 2 issues, the top 2, it's the economy and immigration. As you can see there, Trump leads on average by 8 points on the economy, 15 points on immigration. The next 4 going down, abortion, democracy, healthcare, and senior services, Harris leads. So it's really, to me, a question of what are we going to care about, right? Is this election about the economy and immigration, which I still think is a motivating factor? I still think has a lot of legs on it. If so, then you've got to be bullish on Trump winning. Obviously, if it's about other issues or Trump is unable to pull out of the tailspin he's been in for 3 weeks, then Harris will win. But I caution clients, we will have a reversion to the mean on some of these polling. This horse race will continue to be close because A, I think it is, and B, that's what the press wants it to be. And then third point, final one, is just when does this all start to matter? That's the question I get most. I don't really care about anything until September 10th, which is a presidential debate, and then September 16th, which is when Pennsylvania, which I think will be the state that decides the election, begins their early balloting. So early voting starts on the 16th of September. That's when, the rubber meets the road.
When people start pulling the lever. And then real quick on the Senate side, obviously having a team blue president and a team red Senate, or those 2 being different teams, creates a lot of problems for the president to get his or her agenda through and nominations done. What does the Senate look like? Because I think this one you might speak to a little bit more certainty of than sort of where the White House is, because I agree it's a 2-horse race and it really doesn't matter until people start voting. But what about the Senate?
So on this one, we can moor ourselves with confidence to the idea that Republicans will take the Senate. I think our stated odds are 80% that Republicans will take the Senate, and I go through why here. Republicans only need to net 2 seats. They're going to net one of those in West Virginia, where Manchin has stepped aside, which means that they only need to win 1 more state. And it's a bad map for Democrats. They are defending Montana, a state that Trump won by 16 points. They're defending in Ohio, a state that Trump won by 8 points. So ultimately, we feel confident that Republicans will have a slim majority in the Senate. Obviously, nothing is done until the balloting is over, and even then you got to double check. But this is the one area that I'm mooring myself to, because that gives us some confidence about what a tax package would look like. It gives us some confidence about regulatory pressure on the financial regulator. So I think that this is the one part of an otherwise uncertain electoral landscape where you can have some certainty.
And if I'm and correct me where I'm wrong here, but it seems like we have a bad map one year for Democrats, then we have a bad map for Republicans the next year, and then the third one kind of is a neutral map. I think we're coming out of the neutral one, and then 2026 might be a bad map for the Republicans to defend. So it almost seems like the way it goes that this kind of swings every 2 years. That's either bad Dem, bad Republican defend map. Is that kind of what we kind of foresee over the next couple of Senate cycles?
Yeah, look, there's a brilliance to the gridlock, right? I mean, that's why the Senate exists, and a third is up every 2 years, and so I think that's exactly right and exactly how you should think about it. The one cautionary point with all this, Seth, is I believe that the filibuster is not long for this world. I do think that it's something in the next 5-6 years that will be gone. Schumer, the Senate minority leader at this point, Senate majority leader at this point, has already intimated that he would get rid of it next year if they retain control. So I think that at that point, then perhaps our calculus changes. But for right now, you're exactly right in how you frame it.
All right, well, very good. Well, we're going to pivot now to tax policy because this is also important to our client base. And I know we're going to bring Jake back on the screen here. And this is your slide, Isaac. I know you wanted to cover a couple of things, and this is going to be more you and Jake going back and forth. So you all tell me when you want to move slides forward on the tax side. And remember, if you've got questions, please log them in. And we still do have 2 more polling questions we got to get through. So, but I'll turn this one over to you, Isaac, but this is going to be the Jake and Isaac portion, talking taxes, because God knows nobody wants me doing their taxes.
I think this is going to be the Jake portion, to be honest with you. Look, my call on this is pretty straightforward. We have $4.5 trillion of taxes expiring next year. I think that you will see a fair amount of that package deficit finance. It depends on, of course, the composition. I outline here what I think will happen under each electoral scenario. For the corporate rate, I honestly believe that it's going to stay at 21%, no matter what. I think that it's very difficult to move that one way or the other. It's difficult to move it down because you've already seen deficit fears in Republican circles. And moving it up maybe a point, maybe 2, but the reality is they got rid of so many other deductions back in 2017 that moving it up has really, really negative implications. The most interesting area for me is what they do with capital gains, and if Democrats win, will they remove stepped-up basis for certain certain tax filers based on assets or earnings? All of these different variables are in play. Not just if Democrats win, but with Democrats win, you know the direction it's going to go. It's going to be higher taxes for higher earners. But even if Republicans win, I think that highlights what Jake's going to talk about, which is understanding how all those different dials and switches can impact your business. And I think that's where I'll leave my portion and turn it over to Jake.
Excellent. Thanks, Isaac. I appreciate that. It's a great introduction. Seth, if you want to just go to the next slide, then I can just sort of segue.
We got a quick poll question. So let me do the poll question, but again, got to answer all 3. But this poll question is, what best describes your attitude towards the November, and I guess we could put September 10th, starting presidential election? I have a candidate I support strongly. I have a candidate that I don't support strongly. I'm undecided, or I'm currently writing in Isaac as a candidate based on his commentary, which that's how I would vote. I may actually write in Isaac this year for president. But we'll see how many votes I can drum up for Isaac. But again, quick poll question before we go to the tax, a little bit deeper into tax. But Gabby, when we get to critical mass, let's publish the results. We're not asking obviously who people are voting for. We're just sort of asking why they might be voting.
Right, we're getting close. There might be 1 or 2 still out there. So if that's you and you're looking for CPE, now's your chance to get your poll logged. With that, I'm going to close this poll.
And I can't ever see the results. So what do the results look like?
We're sitting about 50% that have a candidate they strongly support, 25% a candidate that they don't strongly support, 15% undecided, and maybe 11% took you up on that write-in offer.
All right, so 11%. So Isaac, you're polling at 11% based on the Richey May thing. You're in good shape. Well, this will get you some dollars, right, for our campaign.
Thanks, guys. Appreciate that. So I think Isaac, your segue was perfect. I think one thing to consider when we talk about taxes and what that looks like over the next couple of years, I think it's key to remember that we're in an election year, and so depending on which candidate ultimately takes the White House, they've each sort of, in a small way, mentioned what they would do or what sort of they're thinking about when it comes to a tax perspective. As Isaac and Seth and I were talking about preparing for this, it's unfortunate that neither one has really gone into much detail or thought about what their tax sort of changes would look like. You know, at a high level, we've got one candidate saying, hey, I'm going to continue to try to decrease the corporate tax rate from 21% down. We've got one candidate that says, no, I absolutely am going to raise that corporate tax rate by 6 or 7%. But neither really has outlined how they would do that or how that would impact what Isaac pointed out is the deficit and the tax, implications that has. But what we do know is coming as of right now, and unless something changes, is that the provisions that were put in place back in 2018 under the Tax Cuts and Jobs Act, the majority of those, as you can see from this slide, are set to expire at the end of the calendar year 2025, meaning that starting in 2026, there'd be several of these provisions that would revert back to the pre-2018 law as it was written. There would be some that would revert to some difference. But what I want to do in the couple minutes we have before we get to the Q&A is just on the screen here, you see sort of 3 highlighted sections that I think, in my opinion, would have the most impact or could have the most impact if these really truly do expire. The first one I want to mention here is the qualified business income deduction that flow through or pass through entity owners have been able to take advantage of the last several years. So certainly owners of partnerships, owners of S corporations have been able to take up to 20% of their qualified business income as a deduction in their personal tax return. And what that effectively has done is allowed these taxpayers to reduce their tax rate from the highest tax rate down to about 29 to 29.5%, which again gets that tax rate closer to the 21% corporate rate that was put in place. If that provision expires, then those pass-through owners no longer would get that 20% deduction. So effectively what would happen is their tax rate would revert back to the highest tax bracket or whatever bracket they would be in, which if this provision expires, then the marginal tax rates, as we saw in Isaac's slide, would actually incrementally increase. So right now, the highest individual rate is around 37%. Well, if this legislation expires, now the highest rate goes up to almost 40% for an individual, and you take away the 20% qualified business income deduction, that significantly would impact those types of business owners. So as we were talking about, well, what does that mean? It sort of takes us back to what happened in 2018 when this originally passed and the questions that Richey May got about, well, should I convert or should I change my entity from a partnership or an S corporation to operating as a C corporation, and what tax implications would that have? And so again, I think those questions become relevant again, because if you're losing that 20% deduction, being taxed at 40% versus paying tax at 21% is a significant difference if you're an owner of a business. And again, that's oversimplifying it. Certainly there'd be some other things to think about, because obviously as a partnership partner or an S corp owner, there are some advantages when you take distributions from your company, because those are a return of capital tax free. Whereas if you take distributions from a C corporation, you're paying tax again on those as dividends. So maybe not quite as simple as it sounds, but certainly something to think about if these provisions are not extended or if this QBI deduction goes away. The other big one that I think has impacted our mortgage owners is this cap on their state and local tax deductions. So for the last several years, it's been at this $10,000 cap, which for most of our mortgage owners, they their businesses operate in multiple states, meaning they're paying taxes in multiple states, which means they have their ability to deduct those taxes in their personal tax returns capped at this $10,000 number. Over the last couple of years, several states have implemented these pass-through entity taxes that allow them to, sort of take a deduction for those taxes that are paid, and it kind of circumvents a little bit this cap. But I think it's interesting, as Isaac and I were talking about this, is while this, let's assume this provision, this Tax Cuts and Jobs Act legislation expires, I think no matter who the president is and no matter what Congress is looking at, I don't know that they're ever going to completely eliminate this SALT cap again. I think maybe it goes higher, maybe it's 40,000, maybe it's an $80,000 cap, but I think this cap will remain in some fashion. And so do I think that a complete elimination of these pass-through entity taxes is ever going to go away again? I don't think so. Might it change the way that we think about a tax plan regarding all of these state taxes that might be paid? Certainly, I think it would. And so I think as we think about, the impacts of the upcoming election, the impact of this expiring legislation, I think there are certainly some strong considerations and things to think about if neither of the potential candidates decides to extend these provisions or picks and chooses which of these they're going to extend. I think this certainly could impact the owners of mortgage banks, especially those that are currently operating as an S-corp or partnerships. The last thing I just wanted to mention, I know we need to get to our Q&A time, is there was some legislation that was out there recently that had some tax relief in it. A couple of those provisions were they were going to think about how 174 research and development costs could be immediately expensed again versus having to amortize those that we've seen over the last couple of years. There was going to be a restoration of the ability to take bonus depreciation as that keeps falling off the table, and by the end of 25 will be completely eliminated. But as of August 1st, that piece of legislation did not pass the Senate. And so at this point, as far as I understand, it's pretty much dead in the water. So again, that circles back to the importance of what happens in the election, what either of these candidates is proposing and thinks is going to be important for the American people and the economy, and how are their tax ideas and their proposals to save the Americans tax, how that will impact mortgage bank owners. So again, certainly this list, there's some other things on here that would impact taxpayers, but I think as far as owners of mortgage banks, these three that we've talked about, I think are the most impactful and the ones we want to keep our eye on as we think about sort of what happens over the next year. So with that, Seth, I'll turn it back to you for Q&A. And if people want to jump in and ask questions, certainly Isaac's a great resource on all of this, and I'm happy to answer anything I can as well.
Yeah, great. Thank you, Jake. And that was a wonderful update on the tax side. And again, you can reach out to me, reach out to Jake directly. I'll answer any tax questions, the easy ones. I'll turn the hard ones over to Jake. We do have one question that came in, and Isaac's probably for you, but the Chevron ruling from the Supreme Court, and what does that mean for potential like changes with how the CFPB acts? And I guess I'm going to paraphrase it a little bit. Does that mean less formal rulings, and I'm just going to fine you under a Chopra thing and you won't know how to act? Like, can you walk us through what Chevron actually means to potentially the CFPB, who does, let's just say nicely, sometimes put out some guidance or rules that may not be crystal clear?
Yeah, look, ultimately, the only clear winners from Chevron deference ending, in my opinion, are lawyers who have connections to the Supreme Court, because everything will be litigated. Everything will take longer. Within financial services, I've cautioned clients, I don't think that the impact is going to be as positive as some have hoped. Like within financial services, as an industry, we already have the capacity to take any issues we had over to the Fifth Circuit, and things basically stopped there, right? As you've seen with CFPB credit card late fee rule and others. And so, look, I think from a sort of perverse perspective, what this could ultimately do is lead to more regulation by enforcement from the CFPB. as they say, why are we going to go through the time and pain of rulemaking? Let's just keep on throwing stuff at the wall, see if we can get consent orders that signal things to the market, rather than testing our luck with statutory clear statutory actions. So ultimately, I think that it's neutral to slightly negative for financial services. The real winners are like healthcare, where you can see reimbursement rates go higher and things like that. So, yeah.
Well, you got one more poll question for folks then in order to get to their CPE credits, and this one, and then Tyler, I'm coming to you with a question on servicing retained released. So I may ask you that. We may double task here, but the poll question is, what best describes your travel plans this fall? I plan to attend the MBA annual here in Denver. I plan to attend Accounting and Finance Conference, which is Arizona in December. I plan to attend both. I'm not planning on attending either, or I'm still deciding. So as people are going through that poll question, remember you got to answer all, there's the 4 CPE questions to get your credit. Quick question for you, Tyler, on the profitability. Has there been a shift in the Richey May data on retained released that may be like changing that gain on sale number, or has that been fairly constant over the last couple of quarters?
Yeah, good question. You know, through the first 3 quarters of 23, it was basically 70% of loans were delivered to an aggregator and about 30% to the agencies. But moving into Q4 of 23, we actually saw that decrease. So it was more of a 25-75 split. And obviously, I think people are trying to hold on to more cash as they're going into the winter. And that trend has continued on. So we've seen about a 25-75 split even into Q2. So yeah, I think that's what's going on there in terms of retained versus released. And then with the secondary gain on sale, we've actually in Q2, we actually saw some compression over Q1. Q1 was the quarter where we saw a nice lift. So obviously I think they're getting a little bit better pickup, delivering a little bit more to the aggregators there.
Great. Good information. That's not sort of some other shift like that. It's held constant. So that, helps really normalize those numbers, in my opinion. Gabby, how are we doing on poll responses here? We got the critical mass for folks?
Yep, they came in quickly, so we've shut it down.
Okay. And what was the overriding answer?
Over 50% are saying they will not be attending the conference. We still have about a quarter of people still deciding. So very few who are saying that they have plans right now to attend annual, and pretty few saying that they plan to attend AFM as well.
Well, that's consistent with what the data that the Richey May team has here, right? While Q2 was profitable, we're still not profitable for the year, so travel budgets remain tight. The key takeaways from today, outside of everyone being introduced to Isaac who didn't know him, profitability has returned. The average IMB. Elections are going to have huge consequences for not only taxes but leadership. And as Isaac said very well, it's a long way to September 10th. It's even a longer way to November 5th, 6th, whatever that day is the election. So stay tuned. Don't believe all the headlines. I'd like to thank all our panelists. Great job. As always, Isaac and I could talk for hours. Sometimes we do when we get together at a conference. But Isaac, thank you. Thank you, Jake. Thank you, Tyler, for taking the time today. The slide deck will be sent out. And again, as a reminder, please complete the survey. It'll pop up here at the end about the webinar. Tell us what you liked. Tell us what you didn't like. Tell us that you want Isaac to be a regular guest every time. There's more things. Isaac and I had like 3 hours of material. We had to cut it down to 40 minutes. But we really do appreciate it. We take that feedback seriously. Thank you all again. Isaac, Jake, Tyler, great job. Everyone have a great rest of your day, and buckle up to September 10th and the election in November.